Hello, you're watching Market Week in Review for the week ending April 3rd, 2015. I'm Alexandra Davis, coming to you from Russell Investments Global Headquarters here in Seattle, Washington. I'm joined today by Chief Investment Strategist Erik Ristuben. Welcome, Erik.
Good morning, Alex.
Certainly a focus on the U.S. jobs number this morning. The market seemed optimistic about a fall in jobless claims in advance of today's report. Was that optimism warranted?
Well, actually, obviously not, right?
Yeah.
126,000 jobs. It was not a good jobs report. The consensus was about 2.25. Roughly, so it was really far below what people had expected. It also breaks a year-long streak of actually having at least 200,000 jobs created on a monthly basis. So this is a much lower number than we've seen. Now, I think you probably should have expected probably on the weak side because we actually have had bad weather in the first quarter. It looks like we're maybe even seeing the movie we saw last year, which is first quarter, really bad weather. March in particular was bad, and it's having an effect on the economy. You've seen softer economic data come through consistently for the first quarter. Lately, though, the numbers seem to be getting a little bit better. Things like consumer sentiment are high, auto sales have been good, recent ones. So we're thinking we're probably getting past this weather-related issue, and we'll start seeing kind of normal growth throughout the rest of the year. The other thing you saw in the jobs report was that wage growth, hourly wage growth, was not strong. Right, it kind of at 1.8% on an annualized basis. That's right around the 2% it's been hovering at. The Fed, as we've been saying, is watching that data in particular very closely. So I think both of those things, the weak wage growth as well as the weak jobs number, in our minds makes it much more likely that the Fed is going to move in September rather than June.
Okay.
But we still think they're going to move in third quarter.
Okay. Now, if we shift gears, it appears that there's still some indecision over Iran's nuclear program, and it might continue to hover in the coming months. Is that a key watch point for the markets?
Well, I don't know if it's a key watch point. I mean, political, as we've talked about, this kind of geopolitical thing usually doesn't have a huge impact. I think the thing to watch for with Iran is if we were to reach a deal, and it's not just the United States, it's a broader group of nations. If you were to reach that deal, that means on balance, probably people think there's going to be more or at least consistent oil supply. And that is probably, going to put, every time you see advancements in that, you're probably going to see a little bit negative pressure on oil. We saw a sell-off, a very mild sell-off relative to the sell-offs we've seen in oil over the last 9 months, but we saw a little bit of a sell-off yesterday when the preliminary kind of agreement was announced. But on balance, actually, the week oil was up. So I think that's what you watch for, is it on balance. Iran deal makes it the oil supply more consistent, and therefore probably on the margin put some modest downward pressure on oil.
Okay, now to wrap up this week, the U.S. dollar has been somewhat of a rock star performer relative to other major currencies. What's the strengthened dollar impact on the U.S. and global market outlook?
Well, it actually is a headwind for the United States. So our stronger dollar means that our exports are more expensive. So it makes it a little bit difficult for the U.S. economy on average to kind of move forward at the same pace it had. But the good news is that, we are a 70% consumption-based economy, which means a lot of the business, most of the business we kind of do with each other. So you don't guess necessarily the dollar, but the impact really that is most profound in terms of the stock market has been the actual impact and the potential future impact of a strong dollar on earnings.
Okay.
And that's the thing that the market's been really watching. I don't think the softer economic data we've seen in the first quarter is due primarily to the dollar, but I think some of it is due to the dollar. But certainly the earnings deceleration and the lower of earnings forecasts that we've seen throughout the course of the last 6 months, that is principally dollar related as well as energy related, because the energy sector, obviously the earnings have been slashed. On balance, we think that corporate America is going to be able to navigate this reasonably well.
Okay.
Continue to create reasonable earnings growth in spite of a strong dollar. And as I said a little bit earlier, we think that the U.S. economy is going to be able to shake off kind of these winter doldrums we seem to experience a great deal and kind of move forward for the rest of the year.
Okay, well, thank you, Erik, as always, and thank you for watching. We'll see you next time.